The AI trade that dominated Wall Street for the past 18 months just hit a massive wall. Picture this: every analyst, every hedge fund, every retail investor poured billions into AI stocks at the start of the year. Nvidia, Microsoft, Google, Meta, these mega-cap companies that rode the AI wave went up more than 50%, some even doubled. The narrative was bulletproof. AI will transform everything. So the companies at the center of that transformation will become worth fortunes. But in a single volatile week, that entire thesis got absolutely crushed. Trillion-dollar companies started getting sold off hard. AI stocks that were up 100% or more from their lows suddenly looked massively overpriced. At the same time, something unexpected happened: oil prices tanked too. When two completely different sectors both get hit simultaneously, it tells you something systemic is happening. This wasn't just investors taking profits on a winner. This was a reckoning. Wall Street stepped back and collectively asked, have we completely lost our minds with these valuations? Here's what makes this week so crucial. It's not about whether AI is real or valuable. Spoiler, it absolutely is. It's about what happens when pure euphoria crashes into cold reality. To understand this crash, you need to rewind to about 18 months ago. ChatGPT had just shown the world that AI was no longer science fiction. It was real, it was now, and it was intelligent. Suddenly, every company needed an AI strategy. Every earnings call, every investor presentation became about AI. Wall Street analysts started treating any company connected to AI, chips, software, cloud infrastructure, as if it would grow 50% annually forever. Valuations went absolutely nuclear. Companies trading at 100 times earnings, 50 times revenue. Ratios that in normal times would be considered insane became standard for anything with an AI label. Nvidia became the most valuable company in the world at various points. Smaller AI specialists went up 200, 300, even 400%. Retail investors bought AI ETFs. Hedge funds went all in on AI-focused portfolios. The FOMO, fear of missing out, was completely intoxicating. You couldn't escape the narrative. Get exposure to AI or you're going to get left behind. Anyone who dared suggest that valuations were crazy got shouted down. The party felt permanent. But after 18 months of relentless gains, something started to change. Earnings reports came in and companies asked, okay, where's the return on investment? Where's the actual profit from all this AI spending? And Wall Street didn't have a good answer. Here's what actually triggered the crash. It wasn't one thing, it was a pileup. First, corporate earnings reports started showing that while AI revenue was growing, the actual profit margins weren't as spectacular as Wall Street expected. Companies spent $100 billion on AI infrastructure and got back $10 billion in near-term revenue. That math doesn't work at these valuations. Second, the megabanks and chip designers started warning about demand softening. They said the gold rush of companies buying AI chips and renting cloud GPUs was slowing down. People had bought their AI infrastructure, and now they're actually trying to use it, and the payoff timeline is longer than everyone hyped. Third, there was genuine fear about oversupply. Too many companies building the same AI products. Too many data centers built at the same time. Finally, and this matters more than people realize, the interest rate environment started shifting slightly. Money got a tiny bit more expensive again. When money's cheap, investors don't care about profits, they just chase growth. But when rates tick up even slightly, suddenly profitability matters again. And when you look at how much money these AI companies are burning to chase growth with uncertain returns, suddenly the math looks terrifying. It wasn't dramatic news. It was the slow realization that the entire investment premise needed questioning. And that's when panic selling started. Selling wasn't confined to small speculative AI startups. The megacaps got hammered just as hard. Nvidia, the literal poster child of the AI boom, saw its stock down double-digit percentages in days. Think about that. The most dominant AI chip company just had its worst week in months. Microsoft dropped because analysts pointed out that all that money spent on AI infrastructure and R&D wasn't yet translating into actual revenue growth. Google faced similar questions. Where's the payoff from all this Gemini investment? Meta took a hit too. Amazon Web Services, which supplies AI to thousands of companies, saw margin concerns. Even OpenAI, the company that started this entire craze with ChatGPT, faced funding questions. But it wasn't just the mega caps. Every sector bet on the AI narrative got destroyed. Semiconductor companies that only tangentially touched AI. Software companies that slapped AI features on old products. Startups with nothing but an AI-themed pitch deck. All of it got sold. Investors who'd been chasing every AI play suddenly realized they'd been throwing money at companies with no clear path to profitability. The kicker: some of these stocks are still down 30 to 50% from their peaks weeks later. The enthusiasm vanished almost instantly. And that's what makes this moment so instructive about how markets actually work. Here's where the story gets interesting and revealing about what was really happening in markets. Oil prices crashed at the same time. That seems random until you think about what it actually signals. Oil fell because traders thought that if the economy's overheating enough to cause a market correction in tech, then demand for oil might weaken. It's a fear trade. When investors get scared about the economy, they sell commodities alongside growth stocks. This told us something important. The AI crash wasn't seen as an isolated sector problem. It was seen as a sign that maybe the entire economy is overheating, valuations are out of control everywhere, and a broader correction might be coming. That's actually more serious than just AI being too expensive. If major investors thought it was just an AI problem, they'd rotate out of tech into other sectors like energy and utilities. But the fact that energy crashed too showed they were fleeing risk altogether. That's panic selling, not smart reallocation. Traditional sectors like consumer staples and defensive stocks held up better. The market was essentially saying, we don't trust any growth story right now. Oil's weakness also mattered for another reason. It meant inflation might cool down, which could eventually help the broader economy. But for the week in question, the narrative was fear-driven. And when fear drives selling across multiple asset classes simultaneously, you don't get a gentle correction. You get what Wall Street saw: chaos. Let's be crystal clear about what didn't happen. AI didn't suddenly become fake. The technology is real, it's powerful, and it's going to reshape businesses for decades. That part isn't changing. What changed is the valuation framework and investor expectations. For the past 18 months, the only question investors asked was, how does AI help us grow faster? They didn't ask the other questions: at what cost? When do we make actual profit? What if 3 other companies are solving the same problem? What if the demand isn't as strong as we think? Now they're asking those questions aggressively. This is actually healthy for the sector long term, even though it hurts in the short term. It means that AI companies have to prove they can make money, not just have cool technology and a good story. The companies that have genuine business models, strong competitive moats, and real profit paths will recover. The companies that were just riding hype will stay depressed or disappear entirely. For investors, this is a wake-up call. Evaluating technology companies requires more than just understanding the technology. You need to understand the actual unit economics, the TAM, total addressable market, and competitive positioning. The age of buying anything with an AI label just because the sector is hot is over. We are entering an age where individual company execution matters way more. That's a more mature market for AI investing. It's less fun for speculators, but way healthier for everyone else. If you're watching this and thinking about your own investments or portfolio, here's what matters going forward. First, look at profitability. Actual earnings, actual free cash flow, not just revenue growth. AI hype will cycle through again, it always does, but the companies that actually make money will be fine. Second, understand competitive positioning. Is this company doing something genuinely different, or are they just marketing AI better than their competitors? A Me Too AI tool with the same technology as everyone else but worse branding is going to get crushed in a downturn. Third, watch the analyst sentiment pivot. When you see analysts who are bullish starting to lower price targets, that's a real warning sign. They're often late, but they're not random. They are tracking the same metrics you should care about. Fourth, pay attention to insider buying. When executives and board members buy their own company's stock after a crash, that's real conviction. When they sell, that's a warning. Fifth, think about how dependent a company's growth is on external hype versus internal product and market demand. Companies that can grow without needing perfect market sentiment are way safer. And finally, resist FOMO. The market will create another hot sector after AI corrections. It always does. But the investors who made real money weren't the ones chasing hype. They were the ones patiently building positions in solid companies when everyone else was panicking. Wall Street's brutal week revealed something important about how markets work and how technology gets priced. When a breakthrough technology emerges, whether it's the internet in 1999 or AI in 2024, money floods in faster than rationality can keep up. Valuations get completely untethered from reality. And then, inevitably, reality reasserts itself. Some companies survive and thrive through that correction. Others don't. The good news, this correction doesn't mean AI is a bust. It means AI is maturing. It's transitioning from speculative gold rush to actual competitive business landscape. Companies that can execute will capture enormous value. Companies that can't will disappear. For Wall Street, this week was a gut check, a reminder that even the most powerful technology trends can't support infinitely high valuations forever. The investors who bought Nvidia at 200 times earnings just learned an expensive lesson. The investors who bought it at 50 times earnings might actually see real compound growth over the next decade. The difference between those two investor outcomes has nothing to do with whether AI is real. It has everything to do with price and timing. Watch what happens next closely. If the selling continues, that's a deeper recession signal. If markets stabilize and start rebuilding positions in quality AI companies, we're entering a more mature phase. Either way, the age of buy anything AI is officially over. The age of buy good AI companies at reasonable prices is just beginning. That's what this volatile week actually taught us.